They're calling it a rumor, a headline, a spicy take for clicks. But what if it's colder than that? Something structural. Because if India quietly reduced its US Treasury holdings by roughly $50 billion over about a year, falling from around 241.4 B to about 190.7 B, that's not a tantrum, and it's not a single dramatic dump. That's the kind of month-by-month repositioning you only notice if you're watching the plumbing, not the talking heads. And here's why you should sit up straight. This is happening in a world where global debt has been reported near $346 trillion, about 310% of global GDP, a scale where debt stops acting like normal finance and starts acting like gravity. Meanwhile, U.S. gross national debt is being tracked around $38.43 trillion in early January 2026. And just in December 2025, the U.S. ran a record $145 billion December deficit, with interest costs rising again, interest behaving like a second government that never goes away. So no, this isn't a story about India betraying anyone. This is a story about incentives, risk, math. It's the system doing what it always does when the load gets heavy and the margin for error gets thin. Right now, people are still arguing over whether the exit even happened. The machine doesn't care about arguments. The machine cares about risk committees, duration exposure, geopolitical optionality, and what happens to a portfolio when the risk-free asset starts feeling less mentally risk-free. Here's the pattern, and it's not a vibe. It's a repeatable sequence you can trace across reserve currencies and empires like carbon paper. First, a dominant center earns trust. It builds deep markets, predictable law, powerful enforcement, and a trade network that makes holding its liabilities convenient. The world doesn't hold those liabilities because it's romantic. It holds them because, in a messy world, they're the cleanest instrument with the largest market. Then success turns into overuse. Deficits become easier because demand keeps showing up. Credit expands because it's cheap. The reserve asset becomes a sponge for everyone else's surplus. And slowly, the center begins confusing everyone wants our paper with we're disciplined. Then the hairline fractures appear. Not always with a crash, often with subtle stress. Yields rise, volatility returns, politics becomes part of the risk model, sanctions become a financial tool, trade becomes more adversarial. The asset is still liquid, still tradable, still central, but psychologically it changes. It becomes widely used rather than untouchable. And then comes the part most people miss because they're addicted to drama, the quiet exit. Not a headline apocalypse, more like portfolio drift, shorter duration, more optionality, a little more gold, a little less exposure to one issuer, more regional settlement experiments, public statements that say we're not leaving while the spreadsheet quietly moves. That's how reserve regimes erode. They don't usually collapse on television. They degrade on balance sheets. Now I'm going to prove that mechanism 3 times, not because history rhymes, but because when incentives repeat, behavior repeats. Think about Bretton Woods and the dollar's gold link. After World War II, the U.S. is the center. Productive dominance, military shielding, deep finance. Bretton Woods institutionalizes the trust. The dollar is the axis, and gold is the anchor. Holding dollars feels safe because, at least at the sovereign level, the gold promise exists. Then expansion arrives. The U.S. runs larger commitments, war spending, domestic programs, global responsibilities. Dollars flood outward. Foreign holders accumulate reserves. Here's the mechanical detail that matters. The more dollars the world holds, the more the gold promise becomes strained because claims grow faster than collateral. Then stress. Confidence wobbles. Some foreign officials begin questioning the system. Gold pressure builds. Patches appear. Coordination, controls, temporary fixes. But the equation is already broken. Too many claims, not enough anchor. And then the outcome. 1971. The conversion window is shut. The world doesn't wake up and choose chaos. It wakes up and realizes the math already chose. The loud moment simply confirms what the quiet exits and the mounting strain had already made inevitable. Second example, sterling's long retreat. Britain once ran the monetary infrastructure, trade invoicing, finance, empire, London as a clearing hub. The world held sterling because Britain's system was global. But war changes the balance. Britain comes out of financially exhausted. Responsibilities remain huge. Dominance weakens. The center tries to carry reserve status while rebuilding at home. Promises outlive capacity. Then stress arrives as repeated credibility tests. Balance of payment strain, pressure on the pound, episodic wobbles. Britain can delay the reckoning, but it can't cancel it. And then the visible adjustment, devaluation moments, and a gradual shift in global behavior. Sterling doesn't die overnight. It loses reserve primacy because the world quietly stops treating it as the cleanest store of safety. Again, the spreadsheet moved first. The headlines arrive later. Third example, Asia 1997, capital flight mechanics. Several Asian economies build credibility through export strength and semi-fixed regimes. Capital flows in. Investors treat stability as permanent. Then expansion. Credit booms. Foreign currency borrowing rises. Asset prices inflate. And the system begins assuming yesterday's calm is tomorrow's guarantee. Liabilities stack up, especially the kind that must be rolled constantly. Then stress. The question appears, can the peg hold? Once that question exists, the system becomes reflexive. If investors believe others will exit, they exit first. Reserves drain, defenses weaken. Contagion spreads because everyone recognizes the same structure across multiple balance sheets. Then outcome. Devaluations, restructurings, IMF programs, recessions. Not because those societies forgot economics, but because the structure failed once the marginal holder changed behavior. Same sequence, different stage props. Now apply that machine to today, without emotion and without tribal politics. The foundation phase is still real. The U.S. Treasury market remains the world's core collateral arena, deep, liquid, and widely accepted. That isn't flattery, it's plumbing. The system is still functioning. But expansion is impossible to ignore at this scale. Global debt near 346T and the U.S. debt load around $38.43T create an environment where rollover and funding conditions aren't background variables, they're life support. Add to that the U.S. fiscal rhythm, a 145B December deficit record, plus rising interest costs over time. That's not a partisan point, it's the funding model. And then comes stress, the part people misunderstand because they wait for a siren. Stress doesn't always scream first. Sometimes it whispers through the behavior of sophisticated holders. Diversification, duration shortening, incremental trimming, optionality building. That's why the India move matters. Because reporting that India's U.S. Treasury holdings fell from about 241.4B to about 190.7B over the year ending Oct 31, 2025 isn't just a number, it's a behavioral signal. The phrase, "Did India unwind 50B?" makes it sound like a dramatic liquidation. But what's more important is the style of the move. Controlled, gradual, non-panicked. That's what a reserve manager does when they want to reduce risk without broadcasting intent or destabilizing the market they still rely on. That's what a quiet exit actually looks like. And the bigger point is this. It doesn't require India to turn against anyone. It doesn't require conspiracy. It only requires a rational risk committee to look at the board and say, global debt is this high. The core issuer is running large deficits and compounding interest costs. Geopolitics increasingly flows through finance. Duration risk can punish you when yields reprice, so we reduce exposure, diversify, and widen our options, quietly. That's it. No villain, no romance, just math. Here's the part most people don't want to admit. Reserve systems don't crack when one holder sells. They crack when the marginal buyer shifts from must-own to price-sensitive. That's the hinge point. In Bretton Woods, the hinge was conversion credibility. In Sterling's retreat, the hinge was repeated credibility stress and diminished capacity. In 1997, Asia, the hinge, was the moment the market questioned rollover in pegs. In our era, the hinge is whether treasuries remain psychologically default collateral at any price, or whether they become something that needs a higher premium, shorter duration, or smaller allocation. And once the marginal buyer becomes cautious, the system gets more expensive to maintain. Auctions demand more yield. Volatility spikes more often. Funding becomes more fragile. Policy choices become more constrained. And quiet exits start looking like normal risk management until the day the crowd realizes it's a trend. That's the delayed recognition trap. Everything looks normal, right up until it doesn't. So what happens next? Not the dollar dies tomorrow. Not the treasury market collapses this week. The more realistic path is that the system becomes harder to run smoothly. More compensation demanded for risk, more sensitivity to political events, more reliance on domestic buyers or short-term financing, more diversification by foreign holders, incremental, quiet, rational. And if confidence ever breaks, it breaks fast, because modern markets don't unwind at human speed anymore. They unwind at network speed. Final warning, because this is where people lie to themselves. They say, this time is different because the US has technology. Rome had roads, Britain had a navy. Every era has its special sauce. The system still runs on balance sheets. It runs on promises versus capacity. It runs on rollover risk. It runs on how large holders behave when the risk profile changes. So don't make this a tribal story. Don't make it a meme. Don't make it a one-date panic. Make it professional. Track the trend, not the headline. Follow Treasury International Capital data trends and big holder behavior over time. Watch duration. Watch auction tails. Watch volatility. Watch funding stress. Watch how often policymakers have to explain away normal-looking numbers that keep getting bigger. Because if the quiet exits are beginning, whether from India or any other major allocator, the message is not to panic. The message is to stop living inside the old story. The coming shock, if it comes, will not be announced as collapse. It will be packaged as something technical, a disorderly auction. Unexpected volatility, a temporary liquidity measure, a surprise correlation, a geopolitical escalation, a short-term facility. That's how the machine talks while it changes shape. So here's the call. If you want to understand what happens next, you need to understand how reserve systems actually unwind, how they build trust, how they overexpand, how stress shows up in the marginal buyer, and why the quiet exits always come before the loud moment. Because empires don't fall in fireworks first, they fall in spreadsheets. And by the time the fireworks arrive, the spreadsheet has been voting for months,